Hi there, hope you're having a great day. But right now we have some breaking news. At 2:47 a.m. Beijing time, a directive landed in the inboxes of China's largest exporters. Effective immediately, no more US dollar transactions. By sunrise, bond yields were spiking. Wall Street was bracing, and global markets were tilting off axis. 4 words, one directive, and the financial world cracked. No tweets, no threats, just a silent precision. And now, a single question is echoing across every trading floor on the planet. Is this how the dollar loses its throne? Not through war, but through strategic silence. In April 2025, the Chinese Ministry of Commerce quietly instructed over 400 state-owned and private firms to halt all new payments settled in US dollars, according to a leak verified by the South China Morning Post. The directive, described as non-negotiable, wasn't just financial housekeeping, it was a policy shockwave. Bloomberg reported an immediate 12.4% drop in dollar-denominated trade settlement volume out of China within 72 hours. Analysts at ING called it the clearest signal yet that Beijing is institutionalizing de-dollarization. But behind the policy was something more than currency strategy, a plan. The yuan's share in global trade finance, which jumped from 4.5% in mid-2023 to 7.6% by March 2025, SWIFT data is no longer riding momentum, it's being engineered. And with the digital yuan expanding into bilateral energy contracts, China's next move appears to be less about divestment and more about domination. But how does that translate into real-world financial collapse for the US? The fallout began instantly. Within 48 hours of the directive, US Treasury yields surged. The 10-year jump, 38 basis points to 5.09%, the highest level since before the 2008 financial crisis. According to JP Morgan, more than $212 billion in treasuries were dumped in just 4 trading days, much of it traced to sovereign wealth funds and Asian institutional investors. The People's Bank of China had already trimmed U.S. debt holdings from $859 billion in January to $729 billion by March U.S. Treasury Department data. But this marked an acceleration, not a continuation. Mohammed El-Arian Alliance's chief economic advisor warned on CNBC that the shift could redefine the baseline for global borrowing costs. Meanwhile, U.S. bond market volatility spiked to levels not seen since March 2020. This wasn't a glitch in the matrix. It was a strategic signal. If the dollar is weaponized, Beijing will treat it like a liability. But if treasuries are no longer safe, what is dollar dominance has been eroding in silence for over a decade. IMF data shows global central bank reserves held in USD fell to 57.2% in Q1 2025, down from 71% in 2000. But the sudden cessation of dollar settlements by the world's second-largest economy may have tipped the balance. It's not just China, notes Eswar Prasad, former IMF official, in a Wall Street Journal interview. We're seeing a systematic decoupling among BRICS and even some G7-aligned economies. The yuan's usage in cross-border settlements rose to 48% in March, overtaking the dollar for the first time in Chinese trade data history. What's more, Saudi Aramco confirmed its first full oil shipment to India, settled in yuan, on April 18, as reported by Reuters. The reserve currency mantle doesn't disappear with ceremony. It erodes transaction by transaction. So what's replacing SWIFT? And why should Washington be worried? Pause the headlines. This wasn't panic. It was precision. And if this is China's opening move, what's checkmate going to look like? While SWIFT transmits over $5 trillion daily across $11,000 financial institutions, it's built on decades-old infrastructure. China's Enbridge, co-developed with the UAE, Thailand, and the BIS Innovation Hub, just completed a pilot in March, settling $23 million in cross-border trades, nearly real-time, fully traceable, and outside U.S. surveillance. HSBC, Asia's head of digital infrastructure, Ananya Narayan, told Bloomberg that Enbridge proves real-time settlement across sovereign currencies without dollar intermediaries is not just possible, it's imminent. And while the U.S. debates CBDC rollouts, China's digital yuan already processes over $250 billion annually in domestic and cross-border settlements, according to PBOC data from April 2025. This isn't a futuristic proof of concept. It's live and it's working. But as Beijing builds an entirely new financial bloodstream, Trump's response is already triggering monetary tremors at home. President Trump's April 19th Truth Social post was "Blunt cut rates now, or we risk total collapse." Within hours, pressure mounted on the Fed, yet a forced rate cut isn't a parachute, it's a pressure valve. The dollar index dropped from 104.3 to 98.7 in 5 days, the steepest weekly decline since 2009. According to Goldman Sachs, capital outflows reached $76 billion in April's third week alone, led by sovereign sell-offs and corporate hedging. The irony: lower rates may stimulate short-term lending, but erode faith in the greenback's long-term stability. Muhammad Ali El-Arian warned in the Financial Times that artificially cheapening the dollar will only accelerate flight into non-dollar assets, especially gold and yuan-linked commodities. The unintended effect is now visible in forex markets. For the first time in 40 years, the dollar lost value simultaneously against the yen and ruble. So if Washington's fiscal engine is overheating while Beijing rewires the power grid, who's really holding the switch? According to data from the Lowy Institute's Global Diplomacy Index and the IMF's Direction of Trade Statistics, as of Q1 2025, 128 countries now conduct more total trade with China than with the United States. This includes Germany, South Korea, the UAE, and even longtime U.S. partners like Australia and Chile. China's global export volume surged 8.9% year-over-year in Q1 2025, while U.S. exports shrank 3.2% over the same period, according to the U.S. Census Bureau. Bloomberg notes that China's rise is not just due to volume but velocity, ramping up bilateral free trade deals across ASEAN, Latin America, and the African Continental Free Trade Area. In contrast, the U.S. has not signed a major new trade deal since the USMCA in 2020. As economic historian Adam Tooze writes in Foreign Policy, trade is no longer just economic gravity, it's strategic alignment. And more countries are. But if trade flows follow power, what happens when capital flows start reversing too? The U.S. economy contracted 0.7% in the first quarter of 2025, according to the Commerce Department's advance estimate, marking 2 consecutive quarters of negative growth. But that headline masks deeper structural fractures. Real wages are down 2.1% from a year ago. Consumer credit card defaults have spiked to 3.6%, the highest since 2011 per Experian. Small business bankruptcies rose 18% year-over-year in April, according to the Wall Street Journal. Meanwhile, mortgage delinquencies jumped 12% month-over-month, with Freddie Mac warning of a potential systemic stress scenario in its April 17th risk memo. Economists at Morgan Stanley now forecast a 40% probability of a technical depression by year-end, defined not just by GDP, but by prolonged multi-sector contraction. The Fed is cornered raise rates, and the housing market implodes. Cut them, and the dollar bleeds. So what happens when monetary tools become geopolitical weapons? The latest ISM manufacturing index fell to 44.7 in April, its lowest reading since the early pandemic, signaling a severe contraction. U.S. export orders dropped 9.3% quarter over quarter, while import volumes at West Coast ports, long a barometer of global trade health, plunged 27% year over year, according to Port of Los Angeles April data. The American Association of Exporters reports that nearly 1 in 5 major manufacturing exporters have lost access to key Chinese suppliers following Beijing's capital payment ban. Boeing, once America's largest exporter, saw $14.2 billion in order cancellations in the first quarter, more than double fourth quarter 2024 levels per Reuters. Meanwhile, trade credit insurers like Euler Hermes are slashing U.S. exposure limits, citing non-payment risk volatility. If the arteries of trade are clogged, leadership becomes irrelevant. But the deeper question may be, is the real damage coming not from Beijing, but from Washington? The U.S. government's own fiscal behavior is eroding the very foundations of dollar trust. In just the first 4 months of 2025, the federal deficit has already surpassed $1.3 trillion, driven by rising entitlement spending and emergency monetary stabilization efforts, according to the Congressional Budget Office in April. Meanwhile, foreign central bank holdings of treasuries have fallen to 38.6% of total issuance, down from 44.9% in 2019, per the Treasury International Capital Report. China's pullback was expected, but what's new is that allies like Japan and Belgium have also reduced their U.S. debt exposure by 11% and 14%, respectively, in the first quarter alone. Even the Saudis cut holdings to a 9-year low. Mohammed El Arian told Bloomberg, surveillance confidence isn't lost overnight. It's eroded by erratic fiscal management and weaponized economic policy. The U.S. didn't just wake up in a world with fewer buyers, it pushed them away. So the real question is no longer whether the dollar is being targeted, but whether it's being self-sabotaged. So if China is strategically cutting the dollar cord, and the U.S. is fraying it from the inside, who's actually in control of the global financial future? Because as the UN gains, ground treasuries lose prestige, and America's own policies accelerate disinvestment, the next domino might not be a trade deal or a currency swap, but a global reserve rotation. And if that starts, the consequences won't just be on Wall Street. They'll hit pensions, payrolls, and prices in every American household. But here's the part no one's talking about. What if this isn't the final blow, but the setup for something even more disruptive? So ask yourself, is the world preparing for life after the dollar? Or is the U.S. writing its own financial obituary? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen. Thanks for watching. We'll keep an eye on the story and keep you updated.